So we're going to be talking about interest rates, the interest rate markets today. That's what this session is for. I've introduced the concept of the course. If you go through the fundamental course, that's module two of our course. I talked about interest rates now, the market. What controls the market literally is interest rates. Okay, so I want you to think about the interest rate market like this. Think about the iOS operating system for your iPhones. Okay, you have the accessories like the apps, camera, and everything, the interface, and all of that stuff on your iPhone. But what allows it to function, what allows the software to function, is the iOS, which is the operating system for the iPhone. Right? Um, that is what the interest rate market is to trading, to the entire global market. Okay, the interest rate is to the entire global market what the iOS is to the iPhone, because literally everything revolves around the interest rate. Same way everything you're going to do on your iPhone revolves around the iOS, which is the operating system of the iPhone. All right, so now what we're looking for is how we can utilize this understanding of the interest rate market to influence or add or aid us in our trading analysis. That's what we're looking for. Now, the correlation between the interest rate market and the dollar, because now remember, dollar is king, right? Dollar is the leadership asset class, and every other asset class submits to dollar. Be it metals, commodities, currencies, literally everything submits to what dollar is going to do. Okay, and dollar has a very close correlation with its own interest rate. So if we can figure out what the interest rate market for the dollar is doing, then we can figure out majority of the asset classes and their potential directional premise. Okay, and I'll teach you a very wonderful trick to utilizing interest rate market. Now, the first thing you need to have in your analysis is if you have a direction, if you have an item from directional premise, it needs to be confirmed by the interest rate market, and that makes it a very high probability directional premise. Okay. Uh, Now, recently, I've not done a lot of interest rate analysis, but oftentimes behind the scenes, I'm doing my interest rate analysis and looking for directional premises. Okay, so now with the interest rate market, if we see lower interest rate prices, okay, that is going to sorry, if we see lower bond prices, that is going to mean higher interest rates. Okay, lower bond prices equals higher interest rate because the correlation between bond prices and interest rate is that they're oppositely correlated. So what you can see here is a 5 year futures contract of the uh, dollar bond contract. Okay, the 5 year treasury note for dollar, or the US treasury note. Anyone, it's all the same, right? So this is the price of the 5 year treasury note for United States. Now, if we are seeing lower prices on the 5 year treasury note and the 10 year and the 30 year treasury note, that indicates bearish bond prices. Okay, now remember the correlation between bond prices and dollar, right? If we see bearish bond prices, that is going to equate to a higher dollar because it's higher interest rates. Now, let me explain in detail what all of this means. Now, if you go and look at the my watch list on TradingView, you can see I have three. The purple tags are for the interest rates or the bonds. You can see I have three purple tags, which is for the 30-year Treasury bond, 10-year Treasury bond, and also the 5 year Treasury bond. Now, the 30-year Treasury bond is what we know as the long-term view of the interest rate. So, 30-year Treasury bond is a longer-term view of interest rates. The 10-year Treasury bond is an intermediate-term view of the interest rate, and then the 5-year Treasury bond is a short-term view of interest rate because they are all futures contracts. Okay. Now, if we are noticing that the bond market are declining or they're poised to drop lower, that is going to mean higher interest rates. Now let me explain why fundamentally. Because my thing when it comes to teaching you guys is you need to understand the why before you understand the how to apply the concept. And that's why a lot of you guys who go through the courses and the live sessions you do extremely well compared to other people. Because the goal is to understand the why first. Why is this happening? And then once you understand the underlying reason why, you know how to utilize a concept in the right context of the marketplace. Now, let's think about real world applications of interest rates. Okay. Now, interest rate simply means that interest rate simply is the rate of return on a government bond contract. Okay. So if I decided, for example, I wanted to invest in the 30-year treasury bond and the interest rate is 5%, and I also decided, okay, let me try out the UK treasury bond and the interest rate is 2%. Which do you think, as an investor, I would want to invest in as a safe, assured investment? If I had two options, and there was the United States government offering a 5% interest rate on their government bonds, and the UK was offering 2% interest rate on their UK bonds, which, as an investor, would I be drawn towards? Let me ask you guys a question so you can reply on the chat box. Yeah, I understand there's a very few of you guys on here because whenever I do teachings like this, no one is interested in teachings. Everyone only wants to see me trade live. So it's understandable. Someone said United Kingdom. All right, so if you're going to say United Kingdom, can you back up why you're saying United Kingdom? So we have two options. Now let me put it this way for you. Let's say you had $1 million to invest in. You're a very wealthy investor. You've made a lot of money, and you have $1 million, and the $1 million is just sitting around. And you said, okay, let me invest in something that is safe, which is the bonds. Okay, bonds are a safe asset to invest in because it's backed by the government of the country. Now, let's say you want to invest in bonds because you understand your investment is going to be safe, and you're looking at government bonds you want to invest in. And you have two options. The United States uh, Treasury bond is offering 5% return on your investment, meaning at the end of the year, you're going to be making 5% of $1 million is, let's see, and that's $50,000. So you're gonna be making $50,000 as a profit on your $1 million investment at the end of the year, versus the United Kingdom, okay, whose government is offering 2% rate or 2% interest on their government bonds. So if you invested $1 million into the UK Treasury bond, you're going to be making $20,000 at the end of the year. Which one would you, as an investor, be drawn towards? Is it going to be the one of the United States, which is 5% or $50,000 profit, or is it going to be the one of the United Kingdom, which is 2% or $20,000 profit? Exactly. So everyone is going to be drawn towards that of the United States because it's offering higher interest rates. Now, does this make sense? Right? The higher the interest rate, the higher the value of the currency of that country. Now, why is it that the higher the interest rate, the higher the value of the currency of that country? Because for you to purchase the bonds, okay, you need to purchase the currency of the country. You cannot invest in the UK government bonds with dollars. You need to do that in pounds, right? You cannot invest in euro bonds with dollars. You need to do that in euro. So the higher the interest rate, the higher the demand for the currency associated with that interest rate. Does this make sense so far? For all of you guys on the call. Does this make sense? So whenever I ask you guys on the live session, what's the relationship between interest rates and currencies? You should be able to tell me straight away what the relationship is. Higher interest rates equals higher currency prices. Because if we have higher interest rate, that is going to attract a lot of investors, a lot of institutional investors, and they would need to purchase the currency to invest into the bond associated with that interest rate. Does that make sense? Now, how would interest rate influence our decision making on currencies? Okay, now this is fundamental, and we can translate this understanding into technical analysis on our charts. Now, what we're looking at here is the treasury note of the United States. So the U.S. government uh, treasury note, which is 30 year, 10 year, and also the 5 year. Okay, now let me ask you guys a question. If you are seeing the treasury bond prices decline, what does that mean for interest rates? Using our relationship that we talked about initially at the start of the call. If we are seeing US government bond prices decline, what should happen to US interest rates? Should it be rallying or should it be declining? That's the question. Lower bond prices should equate to what? Rallying interest rates or lower interest rates? Exactly, perfect. So they're going to go up. All right, cool. Now, if interest rate is going to go up, what should happen to the dollar? Because dollar is the currency associated with the treasury bond pricing, United States treasury bond prices. So, if we have already concluded that interest rates is going up, what should happen to dollar? Should dollar go up or should dollar go down? I need as much as of you guys on this call to answer, so I know you're actually listening to what I'm saying. No, dollar is supposed to rally. iPhone, dollar is supposed to rally. Okay, dollar is supposed to rally because we have higher interest rates. Now remember what I talked about before. When we have higher interest rates, there's going to be an attraction of there's going to be an attraction by a lot of investors wanting to invest because they're going to get a greater return on their investments. For them to purchase the bond prices or for them to invest into those bond prices to reap the return on their investment, they need to purchase the currency associated with that bond prices. Right. So if we see lower bond prices, that equates to higher interest rates. The higher the interest rate, the higher the demand for the currency associated with the interest rate. So when we see interest rate rally, we need to see currency over the currency associated with that interest rate rally. So in this example, lower bond prices on the United States government bond equals higher interest rates. Higher interest rates equals higher dollar. Does that make sense? What I'm going to do is I'm going to overlay the dollar chart with the bond prices so that you can see the relationship of what I'm talking about. Okay. Now this is the orange line is that of dollar and the blue line is that of the bond prices. Okay. Now look at the relationship just by doing this. And after this call, I want you guys to do an assignment because this is going to be very essential for you as a trader. Now look at this, right? Uh, Here, as dollar started to trade lower, we were consolidating, right? We were in a consolidation of the 30-year treasury bond prices. The moment dollar makes it low and starts to rally, we make a short-term high here and start to decline. Look at this. So we're going to mark out all the levels where we see turn points between dollar and interest rates, okay, or dollar and treasury bond market. Dollar makes a short-term low, interest rate makes an high, starts to drop. Boom, it makes a low. When the bond prices makes a low, dollar makes a short-term high. Look at this. All right. When bond prices makes a low, dollar makes a short-term high. But I want to teach you something, but I want you guys to listen very closely. Dollar makes a short-term high and then starts to retrace back into its overall price range. As dollar is retracing, interest rate is rallying. It's rallying. Now there's a little bit of a lag time here. Um, as dollar makes it slow and starts to rally a little bit, interest rate markets also rallying. Now, where was it rallying up into? It was rallying up into the premium between this overall pricing. If I pull up a Fibonacci year, you can see that it was going up into a premium. Okay, so now there's going to be times where it's just a little bit of a lag time between the interest rate market and the dollar. Usually, just by a few weeks, you're going to get that lag time. Now, but dollar was not really rallying per se. Dollar rallied a little bit here and then went to consolidation. Now, here's the wonderful thing. How many times, let me ask you guys a question. How many times have you seen me call dollar being in consolidation before it actually happens? If you're on this call, you've been a part of the live sessions the last few months, and you see me call consolidation before it ever happens, and the market will do exactly as we want to see it do. How many times have you seen that happen? A lot of times. Go back and watch your recording. You're going to see me call that. How was I able to anticipate that via the interest rate market? Now, let me explain why. If I've done a technical analysis on dollar and dollar's poised to rally, okay, but now the interest rate market is also rallying, this gives you what I call a decoupled market environment. So, for those of you guys asking the question, especially Declan, what a decoupled market environment is, this is a decoupled market environment when dollar and bond prices are going in the same direction. They're not supposed to go in the same direction. So when they're going in the same direction, most likely dollar is going to be out in a consolidation because it's going to be extremely difficult for dollar to rally in a rallying bond prices. Does this make sense? Just off of the relationship I've given you between bond prices and dollar, if bond prices are rallying, dollar will consolidate or will be moderately bullish, but you're not going to see trending environment. Okay, that's the clue. You're not going to see trending environment. So what you have right there is the decoupled market environment. Now look at this. As as the 30-year bond prices is trading back up into a premium over a premium and dollar was rallying a little bit, you can see that the rally in dollar is just short-lived. We have a short-lived rally in dollar and then it just goes into a consolidation. So look at the entirety of this, right? Goes into a consolidation until here. Goes into a consolidation inside of this. The reason why dollar was consolidated was because the bond prices were allowed to trade up into a premium to then offer new shorts or accumulate new short positions to then distribute those short positions. So because this asset was being manipulated up to a premium for accumulation of new shorts, dollar was held in a range, the coupled market. Okay. Now here's a wonderful thing. Once we trade up into a premium, we're anticipating the market to resume bearish. As we make an intermediate term swing eye on the bond prices, we see dollar make an intermediate term swing low on its own price, right? So as dollar is making a swing low, this is making a swing eye, and then we start to see this drop lower, and then we'll start to see dollar rally to the upside. Rallies up, bond prices goes into a little bit of a consolidation. Dollar goes into a massive consolidation. But now look at this. And here's the wonderful thing about the bond prices. Whilst dollar was in the consolidation, the bond market was declining. Okay, let me do this real quick. Okay, bond prices are declining, attacking sales for liquidity. Dollar is in a consolidation. What would this indicate to you as a trader? Dollars in the consolidation. Bond prices are declining. What signal is that for you as an analyst? What does this mean for you as an analyst? Should dollar be going? Is dollar about to explode to the upside, or is it going to just sit sideways still? Exactly. What you have here is a trigger. So you have an insight that almost no one in the entire trading industry has into understanding the relationship between the different asset classes. Right? Whilst everyone's thinking dollars in the consolidation is going to remain stuck in the consolidation, bond prices are declining. Because bond prices are declining, we already know there's going to be an incoming bullishness on dollar, right? So let me do this real quick. I'll pull up dollar, and we're gonna use a pane on this. I'm gonna switch this up to canvas. No, I don't want a new pane. Give me 1 second. Let me try to fix this. Canvas. Okay. All right. So this is a chart of DXY. This is a DXY overlaid with that of the bond prices. Now look at the relationship between this, right? As the bond prices starts to go back up into a premium, which is a small low inefficiency. You can see there's a small low inefficiency there. with a bear shadow block. One, two, three up candle, bear shadow block. As we start to trade back up into a premium, there, dollar is held in a consolidation. The moment we accumulate enough short positions and we break structure to the downside, let's do this here. All right, we break structure to the downside there. As we break structure to the downside there on the 30-year treasury bond, look at what dollar does. Dollar breaks structure to the upside there. That is your bullish trigger on dollar. You already have a bullish trigger on dollar there. Now, let me ask you a question. If you see dollar here, let me see if I can zoom in a little bit. If you see dollar here running sell stops and trading down into a deep discount, but the bond market is at a premium and it's making a lower high and lower low here. This is so wonderful. As the bond price is breaking structure to the downside at a level of premium, you can see lower highs, lower lows, and dollars going lower. Is this a bearish signal on dollar or is this a bullish signal on dollar? Let me ask you guys a question. You're seeing the bond prices break structures to the downside. But dollars also breaking structure to the downside. What is that to you? Exactly what I was looking for. This is what we call professional accumulation. That's the new term. So if you have your notepads, if you have your journal, you want to write things down. Professional accumulation is when we see divergence inside the interest rate market against the dollar. That is professional accumulation. It's showing the institutions they are actively buying up dollar and they're actively selling short on treasury bond prices. This is institutional delivery, pure fundamental price delivery. And guess what the market does? Runs short-term sell stops, chills back down to the bullshit of work, and then starts to rally, starts to rally, starts to rally, starts to rally. Okay, starts to rally to the upside. I think I'll be watching this video again, probably sometime this weekend because this is powerful. This one teaching you guys, it's just wonderful. So good, so good. All right, so now you can see that dollars in the consolidation, but now interest rate market is declining lower. Now, what would this indicate to you as a trader that we are bullish? Now, can you remember when we called bullishness on dollar somewhere around here in our live session? I think so go back to 3rd of May. Let's see. So if you go and look at the commentary folder and look at, so not May, February. So if you go to our commentary folder and look at what this month was doing. I don't know why this is lagging, but let's see. So I think probably watch the recording on the 4th of February because that was when dollar was trading somewhere around here. I look at our bias, okay? So you already have access to the folder. Go and watch the analysis I did on the 4th of February and look at the bias we gave on dollar, right? We have a bounce price range inside of this, and we're looking for bullish rises on dollar because the bond market was dropping lower. And then look at what the market does, all right? Trades back down into this small inefficiency there. And if I use the replay tool, just watch what it starts to do. It starts to trade back up to the upside. As the bond market trades lower, dollars trading bullish. Dollars trading bullish. Now we have a point where they're both trading the same direction. They're both trading the same direction. One up candle, another up candle, then a down candle. Here you have one, two, consolidating until we have this down candle, and then the market goes up. What would this indicate to you as a trader? We are running buy stops back into a level of premium to then decline lower. Notice how when the bond price is running up, dollar does not expand to the upside. Dollar simply consolidates here. Okay, from this down candle here. As it starts to run up to the upside, dollar does not really explode to the upside. It just consolidates. The moment the bond prices starts to decline, and then we see another expansion here. We see lower prices on bond prices, dollars consolidating, then all of a sudden, boom, we expand to the upside. Again, same situation here. Lower bond prices, dollars consolidating, we're anticipating bullishness. Lower bond prices, dollars consolidating, we're anticipating bullishness. So the bond prices can be a trigger for directional premise on dollar. And if you have a directional premise on dollar, then you already have majority of your work cut out for you on your other asset classes, be it metals, gold, silver, uh, oil, USD CAD, the majors, the crosses, because everything is all related to the dollar. So once you figure out the directional premise on dollar, everything is figured out for you on the other asset classes. Let me see if there's questions here. Could I please send the photos of the month? Yeah, I'll send them after the call. Now, let me teach you something with bond prices. So the first I needed to do was I needed to figure out the relationship between the treasury bond prices, the U.S. treasury bond prices relationship with dollar. Now, the next one I want to show you guys is a very neat trick for you. All right. Now, let me ask you guys a question. If we are seeing lower bond prices on the U.S. treasury notes, what should that indicate for fiber and cable? So fiber is Euro, U.S. dollar, and cable is British pound, U.S. dollar. So if we are seeing bearishness on treasury notes, U.S. treasury notes, what should both your dollar and JP's dollar be doing consequentially? Exactly. Bearish for foreign currencies. Okay. I'll teach you how to utilize bond prices on the lower time frame. Bearish for foreign currencies. That's what we're looking for. A decoupled market is the market where dollar and treasury notes are going in the same direction. That is a decoupled market. Okay. It's usually indicative of accumulation or institutional distribution. Okay. So when you see them both going in the same direction, then one is being manipulated and the other will be held until the manipulated asset starts to go in tandem. Then you can see correlation come back into the marketplace. Okay, that is what the decoupled market is. Bearish treasury notes equals bearish uh, foreign currencies. Why should bearish treasury note be bearish foreign currencies? Because bearish treasury notes equals bullish dollar. Bullish dollar equals bearish foreign currencies. Thus, bearish treasury notes equals bearish foreign currencies. Does that make sense? Okay, let's do it this way. T bonds. Okay, now let's use U.S. T bonds. Let's do 14. Okay, U.S. T bonds there. Uh, DXY here. Here USD is here. GBP is here. US oil is here. USD CAD is here. USD CAD, no USD CAD. So let's do this. All right. Dollar, fiber, cable, US oil, loonie. Okay. So we have one, two, three, four, five, six assets. If we are seeing bearish treasury bonds, we're going to see bullish dollar. We're going to see bearish euro. We're going to see bearish British pound. We're going to see bearish oil. We're going to see bullish dollar CAD. Does this make sense? Metals. Yeah. All right. Let's do it this way. Gold. Okay. Indices. Let's talk about the indices also. S&P, Dow, Nasdaq. Okay. They're all indices. Showing you guys the correlation between everything. Okay. If we are seeing bearish indices, we need to see bearish dollar, gold, bearish bond prices, bullish dollar, bearish euro dollar, bearish British pound, bearish oil, bullish USD CAD. Now, sometimes gold can go into the same direction as dollar. When can gold go in the same direction as dollar? When there are major geopolitical events like war, the war with Ukraine, for example, we saw dollar and gold go in the same direction. Coronavirus, for example, we saw dollar and gold going in the same direction. When there are major geopolitical events, dollar and gold will go in the same direction for a brief period of time. Okay, because there's going to be a flight to safe haven investment or safe haven assets. Dollar is still considered a safe haven asset. Gold is also still considered a safe haven asset. What happens is institutional investments are pulled away from other asset classes and dumped on the safe haven assets because investors they do not want to lose their investments or investment portfolio. That's what they do to hedge against risk in the marketplace. That is the only time you're going to see dollar and gold go in the same direction, but only for a brief period of time, like a few days or a few weeks or a month. Other than that, normal correlation between dollar and bond and gold is bullish dollar, bearish gold. Everything else is bearish except USD CAD because of its positive correlation with DXY. And US oil, yeah, US oil is also there. Does this make sense? Do we understand the correlation so far? Let me ask you guys a question. Do we understand the correlation so far? Beautiful. Is this being recorded? Yes, sir. It is being recorded. It is being recorded. Being recorded. Being recorded. Let me ask you guys a question real quick. For those of you guys on the live session, would it be okay for me to make this video available on Twitter, or should I not? Because I wanted to do just premium and again. So the stuff I wanted to do on Twitter is the basic stuff and not the more complex things I teach, like institutional delivery and all of those different things. Do you think it's okay for me to make this video available on Twitter, or is it too good for me to make it available on Twitter? We should do. I should just do something else. What do you think? I know it's up to me. That's why I'm asking you as a question. I need to talk to you, of course. All right. Okay. All right. Thank you, guys. All right. So now let's talk about the final piece of the puzzle. Let me check the chat box real quick. It's your content, of course. But again, you guys are paying for this, so I want to make sure that I don't give them up to have the value that you guys got on here. So let's talk about the last piece of the puzzle. Let me get rid of all of this. And what we want to talk about is the relationship between the three treasury bonds. Now, remember, when I started out the call, I mentioned, let me see how long we've been doing this webinar for. It's like an hour plus, hour plus of me talking. Oh, it's actually 34 minutes. It's decent. Okay, so when I started out the call, I mentioned that we have the long-term view of the treasury bond prices, which is 30-year treasury bond. We have the intermediate-term view of the treasury bond prices, which is a 10-year treasury bond, and then we have a short-term view of the treasury bond prices, which is the 5-year, excuse me, the 5-year treasury bond. Okay, so now the same way we can utilize SMT divergence between dollar and euro dollar or correlated assets is also the same way we can utilize institutional divergence or divergence between the three bond prices to give us a supporting signal on our dollar direction. Now, let me show you an example. Okay, watch this. If you go on and look at euro dollar, or let's do this instead. Now, look at euro dollar on the 31st of March. Okay, we had a short term high here. The market runs up above short term high, taking out the liquidity there. We have a breaker block. Okay, this is a breaker block here. Last down candle prior to expansion to the upside is the breaker block. Take out the Euro Fibonacci, and you can see the market trades up to the 50% of the range of the entire price range. Market trades up there. Almost got up into that, okay? But still inside of the breaker block. Now, we're trading inside the breaker block. Our anticipation is bearishness on dollar. But what will confirm if we're bearish or bullish? What will confirm this as a bearish or bullish? Now, the question is, if we're looking for a bearish euro dollar, what should bond prices be doing? Is this supposed to rally or is it supposed to also decline? If we're looking for a bearish euro dollar, should bond prices be rallying or should they be declining? Exactly. It should decline. Now let's go and look at treasury bond prices on the 31st of March, which is when we believe euro dollar should start to decline. So let's look at 31st of March. Now look at what's going on here. When euro dollar is at its breaker block and we're anticipating bearishness coming to the marketplace and a long-term swing out to form, we are seeing the 30-year bond price trade up into a small little inefficiency. Okay, so we have this, make it purple. I'll make this black. Okay, so at the time when euro dollar was making a swing guy, the 30-year bond price was trading up into its breaker block with an inefficiency here, right? We have a small little fair value gap, bearish fair value gap here. Mr. Shallow obviously is bearish, okay? And we run a short term high and we're starting to decline. Now, look at the wonderful thing about this. If you compare with the 10-year treasury bond and the 5-year treasury bond, by the way, the code for the 10-year treasury bond is ZN on TradingView or barter.com is ZN. Okay. The code for the 5-year treasury bond is ZF, F standing for 5. The code for the 30-year treasury bond is ZB. Okay. B is bond price. So if I do a comparison between the three interest rate triad, you can see that the 10-year was making lower high. Okay. Lower high on the 10-year treasury bond, lower high on the 5-year treasury bond, but higher high on the 30-year treasury bond. Okay, so let me get rid of this. Remove all of this so it makes sense. Higher high on 30-year treasury bond, lower high on 5-year, lower high on the 10-year. What is this? This is what we call professional distribution because we're seeing a cracking correlation. You're not having your focus on any one of them. All you're simply looking for is this. You're looking for divergence. If you have a bias on dollar, okay, if you see a bias confirmed with a divergence of the interest rate at a support level or a resistance level, that let me explain. Let me explain something. Okay, let me make something extremely clear. Whenever you have a bias on dollar or foreign currency, and that bias is backed by interest rates, that is the greatest backing you have of institutional sponsorship. That is your understanding of institutional sponsorship because the market moves because of the interest rate market. Remember the analogy I used between the interest rate market and the iPhone. Without the iOS operating system, the iPhone is not going to work. Without the interest rate market, the entire intermarket is not going to be as correlated or as smooth as you want. Once you see that signal from the interest rate market, once it fires a signal in form of a divergence, if you're bearish on foreign currencies, you're looking at divergence at the highs at the level of premium. This is a premium level, okay? If you see divergence when dollar is trading up at a premium, when you're anticipating shorts, you are going to see the greatest move. Look at this. Look at this movement in dollar. Once we confirm our bearishness is confirmed with interest rate market. Look at the move on dollar. Look at this. Look at this. From the swing guy where we analyze divergence all the way down to the low here, that is 700 pips. 700 pips over the space of a month. If we did this with gold, let's look at gold. So one of you guys were asking about metals. 31st of March going into 1st of April. 31st of March here on gold. What was gold doing prior to that? Gold was consolidating. Okay, we are in a consolidation. So let's do the market profile. We have the consolidation here. And we break out of the consolidation inside this candle. So what I'm going to do is I'm going to cut all of this off. Let me cut it off. Gold is in a consolidation. Bond prices are declining. Once you see gold break to the upside out of this consolidation, do you automatically think bullishness or do you think manipulation? Let me ask you guys a question. Again, I'm showing you how you can use this for all the asset classes. Once you see gold break out of the consolidation, do you automatically think buy bullishness? Or what do you think? When treasury bond prices are declining, exactly. So you already know that this run up is false. Why should I run up the false? Because the bond prices or the bond market is declining. And guess what happens? Once we trade up into the premium, it kicks in. Once you trade up to the level of premium, kicks in. You have a power theory here. And you start to see gold start to really, really decline. Really, really, really decline. The trigger on this sell was the bond market all along. All along, the trigger was the bond market. Lower bond prices. If bond prices are lower, it's going to be very difficult for gold to rally in lower bond prices. Does this make sense? All right, so this will conclude today's. Can I talk about lower time frame analysis? It's just the same thing. We'll do lower time frame analysis another time because I'm looking at the time of the session. I don't want to get to an hour, so we're going to have to